How's it going, good people? My name is Jared Ace and welcome back to MoneyMetEish. We've officially passed the halfway point for the year, and so in today's video we're going to have a look back and see how the MoneyMetEish EasyEquities portfolio has performed not only in June but for the whole year from January till today. But before we get started, please remember to hit the like button, subscribe down below and ring the bell to be notified when we upload new videos. If you are struggling to pay down your debt or you feel like you are always ending up with more month than money, send us an email at MoneyMetEish@gmail.com or contact us via Twitter or Instagram to find out more about our new program, MoneyMetEish Cash Coach. We'd love to assist you in setting up a debt repayment plan or just giving you the guidance that you need to finally get and stay on that budget. So if you'd like to get your finances in tip-top shape, contact us down below. And now, into the video. At a total portfolio level, we were able to put 7,000 Rand in both mine and Mrs. MetEish's EasyEquities portfolios this last month, which went into both of our tax-free savings accounts. That brings our contributions to the year to 14,000 Rand each, and we will have both of our tax-free savings accounts maxed out in about 4 months' time. The MoneyMetEish EasyEquities portfolio is currently sitting at 124,000 Rand, with 17,000 of that being profit at around 16%. Over the last month, we have received 121 Rand and 44 cents in dividends, which I'm quite chuffed with, and all of those dividends went back and were reinvested into their respective stocks that paid us. The majority of it coming from Affine Investments. Now, let's have a look at how each account has performed, starting, as always, with the US account. I think few people would have predicted on the 1st of January just how well the US market has performed so far this year. The S&P 500 is up 16%, with the Nasdaq 100 up a whopping 40% year to date. Now, this has not only had a great impact on our US account, but also on our tax-free savings account, which you will see in later segments. Our US account is up 2% in the last month and 17% from January, where we were actually sitting minus 2%. And this has taught me some rather basic, although very often ignored and vitally important to remember lessons, such as the price that you buy a stock at is vitally important. This is especially made very clear to me when I see the fact that Alphabet, Amazon, and Cloudflare are some of the best performing stocks this year, all of them up more than 30%. However, our holding of these stocks are down 9, 7, and 18% respectively, simply because we bought them at ridiculously high prices. Looking at the winners and losers, both for June and year to date, we have the winner for the month, which was Tesla. It was up 28%. And it seems to be able to withstand the onslaught from competitors, the weird and wild antics of its CEO, and a possible pending fight between Elon Musk and Mark Zuckerberg. However, I don't feel like any of those are the actual reason why the share has done so well in the last month. I think it might do a little bit more with the fact that we might finally get some more of Elon Musk's attention in the business, with him having appointed a new CEO at Twitter. What do you think is driving the Tesla price up? Let me know in the comments down below, where you can also let me know who you think is going to win the fight between Elon Musk and Mark Zuckerberg. The winner for the year is, without a shadow of a doubt, Nvidia. It's up almost 200% year to date, which prompted me last month to trim our position by 30%. Since then, the price has just continued to climb, and it's difficult not to see this price as rather bubbly, especially when you consider that a large portion of what is driving Nvidia's price up is AI, and a lot of AI companies have recently been seeing double-digit dips in their share price just in the last 2 weeks, even though Nvidia keeps on climbing. As it reaches an almost 200% gain for us personally, even while the price to earnings, price to book, and price to free cash flow metrics are completely through the roof, it seems as if the price has been detached from the fundamentals of the company for a really long time, and the only thing that I think is still pushing the price along is now just momentum. I don't know how long this can keep holding though, as like I've said already, a lot of the other AI-focused companies have been seeing rather large falls in their share price in the last month, and especially in the last 2 weeks. So, how long can Nvidia keep going up? I'm not sure, but it does lead me to wonder if I shouldn't maybe take some more profits out. Like I said the last time, no one's ever gone broke by taking profits. But let me know what you would do in this situation. You've got a stock that's almost up 200%. It's completely detached from its fundamentals. Do you take the profit, or do you try and squeeze out whatever is left before it falls off a cliff? Let me know in the comments below. Looking at the loser for the month, it kind of gives us another viewpoint on why I think the Nvidia share price is being pushed mostly by momentum, and that is because the loser for the month is Cloudflare. Despite it having a massive run-up in the last month, especially driven by that AI aspect, it has taken a 5% knock in the last month. Now, that is sort of in line with where the other AI companies have been falling. But it does give me just that little bit of an idea that maybe the AI bubble is about to burst. Despite the little wobble that it has had recently, it's had a monstrous rise this year. Once again, showing us that the price you buy a share at is vitally important, since even though it's gone up almost 30% this year, we're still down 18% holding the stock. The loser year to date is honestly rather surprising to me, both because we've seen really great gains recently by holding this company, and also just looking at the general way the world is at the moment, I was really surprised to see that the loser year to date is actually Lockheed Martin. The arms manufacturer has fallen 5% year to date, and it really was surprising to me, especially considering that Ukraine is currently going on a counteroffensive. There are massive pushes to rearm Germany and Japan, and just the general escalation of military rhetoric around the world, especially with the rivalry between the US and China on both sea, in the air, just about everywhere. Now, one thing that I think could be driving this share price downward is that the rest of the market seems to be rather bullish at the moment, and maybe the predictable earnings and dividends from a company like Lockheed Martin and Raytheon as well does seem a little bit more conservative, and so the riskier money is moving out of Lockheed Martin and into riskier plays where they think they are going to get more returns. Of course, I could be wrong. Let me know if you think I've missed something in the Lockheed share price down below. Also, let me know what you think actually drives the share price for these arms manufacturers. Now, the US account has been good so far. I cannot complain about a 17% gain, but it really has also humbled me quite a bit, especially with those 3 holdings that we've had, which are still perma-red. And now let's have a look at a proper bloodbath, the ZAR account. The JSC has been taking beating after beating lately, and I can only but wonder if the market is actually starting to mirror more closely the actual on-the-ground economy in the country, since for the last couple of years, despite the economy getting worse and worse, the JSC has been on a tear of note. Could also just be that because the US is doing so much better, all of the money that was in emerging markets has decided I don't need this stress anymore in my life, I'll just go back to the US. That could also be a possibility. What do you think? Let me know your thoughts and your feelings. The winner for the month was ShopRite, which had an absolutely stellar June, wiping out almost all of its losses for the whole year at 16.5%. The fast-moving consumer goods sector really did have a great month last month though, with Woolworths, ShopRite, and Pick n Pay all getting double-digit growth, despite the fact that Spar said they weren't going to be paying a dividend, and Pick n Pay had to pull out of a massive property deal. I think what might be happening is that since this is such a large energy sucker in terms of their actual operating stores and their distribution hubs, the fact that there hasn't been that much load shedding in the last 2 weeks might signal to the market that maybe there won't be such high expenses. But we'll have to see how the rest of the year plays out in terms of load shedding. That's what I think. Let me know what you do down below. The winner year to date is Mustech, up 16% and really driving the charge for our 5 shares that we chose for the Crystal Challenge. It's kind of having to do a lot of heavy lifting since African Rainbow Minerals is down 30%. So thanks for Mustec to actually trying, I guess. The loser for the month was also the loser year to date, and that is Purple Group, whose rights offer was oversubscribed by 13%. And my feeling about Purple Group at the moment is I don't see where the growth is going to be coming from in South Africa. We've given management a lot of time to get Australia up and running, and it doesn't seem to be doing so. And it's nice to see movement in the Philippines, but you've got the cash now. It's time to start delivering on some of the products that you have been promising for over a year. Maybe I'm just being a bit harsh, but I do feel like it's really time for us to see some better execution from the team. If they need to be employing more people, they need to be doing that because we need to start seeing some better returns. The board is really good at talking to investors and keeping them engaged, but I can't help but feeling the time for talk is over and the time for showing us results is getting pretty close. If you feel the same, let me know, and if you feel like I'm being a bit too hasty and we should still be backing management 100%, let me know there as well. Give me a reason why I should dream again. And that leads us to the final account, our tax-free savings account. It's often said that a rising tide lifts all boats, and not only is that evident in our US account, but especially so here in our tax-free savings account. Since it makes up the vast majority of our portfolio at 73% or 92,000 Rand, whatever happens in this account ripples across the rest of the portfolio in a really big way, especially if those movements are happening in the US. Looking at the winners and losers, despite the winner for the month, the Signia Fourth Industrial Revolution, being up 3%, it is still down a painful 12% overall because price. The winner year to date is the Nasdaq 100, which is up an absolute mind-blasting 54% this year. In recent times, I've been wondering whether owning both the Nasdaq 100 and the S&P 500 is a bit of over-diversification, since there is a lot of overlap between the two, but I really can't come to any sort of concrete conclusion. So, if you think holding one is better, which one would you hold? Or if you think holding both is perfectly fine, let me know why. The loser for the month, and I really feel bad calling either the losers for the month or year-to-date losers, because it's a wonderful problem to have when even your losers are gaining, but they were the worst performing over these two periods. So, the loser for the month is the Core Shares Global. We bought an extra 2,250 Rand of the Core Shares Global with this month's allocation, and it is only up 0.15%. The rest of this month's allocation went to the Signia S&P 500, and the year-to-date loser, even though it did gain 16%, it's a far way off the 20 to 50% gained by all of our other ETFs this year, the Satrix India. I still have a lot of conviction for Satrix India. I still believe in the Indian economy and that it has a lot going for it in the near and medium future, but it is the worst performer we have had so far this year, and with next month's allocation being bought in, it will put us just around 10,000 Rand, which is my goal for the year for this fund. Overall, and wrapping up, I made one purchase this month, and that is the Vanguard S&P 500 VOO. I'm going to use the fund as a place to keep my free cash, even though I know that putting it in the market is subjecting it to risk. I really just don't want the funds sitting in the account, and I can't think of a better place to put it where it will be so easily accessible in the account when I need it. If you have a better idea of where to keep my free cash for my USD account, or even where you keep your free cash, please let me know down below so I can have a look at that as an option as well. In the meantime, if I do have any more funds that I'll be selling out of Nvidia, they're gonna go in there as well. So that is the only purchase that I have made. So far it's gained 0.33% between yesterday and now when I bought it yesterday. So major gains on that front. Anyway, let me know where you keep your free cash in the description below. So that is how the MoneyMetEish EasyEquities portfolio has performed in the last month and so far this year. Let me know how your portfolio has done. Let me know what the winners and losers are in your portfolio down in the comments below. If you'd like our help of better tracking where your money is going, getting on a budget, and finally whooping that debt, contact us in the description below. Thanks for watching, and I'll see you next week.